Have you thought about a dividend reinvestment plan? It's also known as a DRIP. When an investor is enrolled in a DRIP, it means that incoming dividend payments are used to purchase more shares of the issuing company automatically. Many businesses offer DRIPs that require investors to pay fees. And obviously, paying fees is a negative for investors. As a general rule, investors are better off avoiding DRIPs that charge fees. Fortunately, many companies offer no-fee DRIPs. These allow investors to use their hard-earned dividends to build even larger positions in their favorite high-quality dividend-paying companies for free. Dividend Aristocrats are the perfect complement to DRIPs. Dividend Aristocrats are elite companies that satisfy the following. 1, they're in the S&P 500 index. 2, they have 25 plus consecutive years of dividend increases and meet a certain minimum size and liquidity requirements. Now, before I begin, this video is brought to you by SureDividend. SureDividend helps investors find high-quality income securities for their retirement and financial freedom portfolios. And the SureDividend newsletter analyzes their top 10 high-quality dividend growth stocks each and every month. Stay tuned, and I'll be giving you a coupon code for a really nice discount. Okay, so think about a powerful combination, DRIPs and Dividend Aristocrats. You're reinvesting dividends into a company that pays higher dividends every year. This means that every year you're going to get more shares, and each share is paying you more dividend income than the previous year. And this makes a powerful and cost-effective compounding machine. In this video, I'm going to introduce the top 15 Dividend Aristocrats that offer no-fee DRIPs, ranked in order of dividend yields from lowest to highest. And be sure to watch the area at the bottom of the screen for the ticker, the dividend yield, the price to earnings ratio, and market cap for each stock. Okay, folks, let's get started. Number 15 on the list of no-fee DRIP Dividend Aristocrats, we have S&P Global, a worldwide provider of financial services and business information with revenue of nearly $8 billion. S&P Global generates about half of its operating income from its ratings segment, 30% from market and commodities intelligence, and the balance from S&P Dow Jones indices. S&P Global's revenue is split roughly 55-45 between U.S. and international respectively. S&P Global has paid dividends since 1937 and has increased its payout for 48 years. They've also generated strong growth in the past several years. S&P Global's business has benefited from a series of favorable secular trends. Since the Great Recession in 2009, the total corporate debt has been on a steady rise, which means more ratings are needed. Lower global interest rates have continued to lead to more and more issuances of debt. In addition, the company has 3 other very strong segments that aren't as dependent on rates remaining low, should they rise again in the future. Investors are also becoming increasingly sophisticated, and so they demand more real-time data and analytics. Also, there's an accelerating demand for index-related investments such as ETFs. Number 14 on the list is Sherwin Williams, a dividend aristocrat founded all the way back in 1866 and headquartered in Cleveland, Ohio. Sherwin Williams is North America's largest manufacturer of paints and coatings. The company distributes its products through wholesalers as well as retail stores, including a chain of more than 4,900 company-operated stores and facilities to 120 countries under the Sherwin Williams name. The company also manufactures Dutch Boy, Pratt & Lambert, Minwax, Thompson's Water Seal, Krylon, Valspar, which they acquired in 2017, and other brands. And even with the coronavirus pandemic severely impacting the economy, 2020 was another year of growth for Sherwin Williams. For the year, Sherwin Williams generated $18.36 billion in 2020 sales, representing a 2.6% increase compared to 2019. Adjusted earnings per share equaled $24.58 per 2020, a 16.4% increase compared to 2019. Sherwin Williams is not necessarily in a high-growth industry, but its entrenched position offers the company its fair share of competitive advantages, allowing the business to grow organically. Further, acquisitions are a way for Sherwin Williams to enhance its presence, with the recent Valspar transaction being a really good example of that. Okay, so number 13 on the list of no-fee drip dividend aristocrats is A.O. Smith, a leading manufacturer of residential and commercial water heaters, boilers, and water treatment products. A.O. Smith generates the majority of its sales in North America, with the remainder from the rest of the world. It has category-leading brands across its various geographic markets. And the company is probably best known for its water heaters. A.O. Smith has raised its dividend for 26 years in a row, including an 8.3% increase in October of 2020. Its long history of dividend growth is the result of a leadership position in its industry and a high historical growth rate. A.O. Smith operates in a growing industry with a particularly attractive long-term growth catalyst in emerging markets. The trade war and the coronavirus have dented emerging market growth in recent quarters, but should not impact A.O. Smith's long-term growth. The long-term growth potential in emerging markets remains very favorable for water purification and heating products. The company is also poised to keep growing for years in China, thanks to the country's huge population, its robust GDP growth, and a booming middle class. India will also be a major growth market for the same reasons. Number 12 on the list of stocks with a no-fee drip program is Abbott Laboratories, one of the largest medical appliances and equipment manufacturers in the world, comprising of 4 segments: nutrition, diagnostics, established pharmaceuticals, and medical devices. Abbott has increased its dividend for 49 years, including its impressive 25% dividend increase. And if they do it again, they're going to become a dividend king, having increased their dividend for 50 years in a row. Diagnostic sales continue to be propelled by demand for COVID-19 tests. Next on the list of no-fee dividend aristocrats is Chubb Limited, a global provider of insurance and reinsurance services with headquarters in Zurich, Switzerland. The company provides insurance services including property and casualty insurance, accident and health insurance, life insurance, and reinsurance. The current version of Chubb was created in 2016 when Ace Limited acquired the old Chubb and adopted its name. Chubb has a large and diversified product portfolio. The diversified product line served the company well in 2020, as it was able to remain highly profitable and even produce some growth. For 2020, Chubb reported core operating income of $7.31 per share. In the first quarter of 2021, revenue of $8.2 billion increased 6% year over year. Number 10 on the list of no-fee drip dividend aristocrats is Illinois Tool Works, a diversified multi-industrial manufacturer with 7 unique operating segments: automotive, food equipment, test and measurement, welding, polymers and fluids, construction products, and specialty products. In the first quarter of 2021, ITW reported 10% year-over-year revenue growth. Earnings per share of $2.11 rose 19% from the same quarter a year prior. The company also updated its full-year guidance, now expecting 12 to 14% earnings per share growth in the full year. Illinois Toolworks industry is not a glamorous one with outstanding growth rates, but the company has established itself as a major player that continues to grow profitably. Its experienced management and strong fundamentals, such as an above-average return on capital, function as competitive advantages. Next, we have Emerson Electric, and they're just not a dividend aristocrat, but a dividend king, having increased its dividend for over 60 years in a row. Emerson Electric was founded in Missouri in 1890. Today, its global customer base affords it $18 billion in annual revenue. Emerson is organized into two major reporting segments called Automation Solutions and Commercial and Residential Solutions. Automation Solutions helps manufacturers minimize energy usage, waste, and other costs in their processes. The Commercial and Residential Solutions segment makes products that protect food quality and safety, as well as boost efficiency in the production process. Now, 2020 was a difficult year because of the coronavirus pandemic and the ensuing impact on the global economy. Yet, Emerson remained highly profitable, which allowed it to continue increasing its dividend. And the company recently concluded its fiscal 2021 second quarter. In the most recent quarter, results came in ahead of expectations on both the top and bottom lines. Total sales were up 6%, and organic sales were up 2%, which excludes favorable currency of 3% and an impact of acquisitions of 1%. Revenue beat the company's guidance, with strength seen across its segments. Next on the list of no-fee drip dividend aristocrats is Hormel Foods, which was founded way back in 1891 in Minnesota. Since that time, the company has grown into a giant in the food products industry, with nearly $10 billion in annual revenue. Hormel has kept with its core competency as a processor of meat products for well over 100 years, but has also grown into other business lines through acquisitions. Hormel has a large portfolio of category-leading brands. Just a few of its top brands include Skippy, Spam, Applegate, Justin's, and more than 30 others. Hormel reported their second quarter earnings on May 20th, 2021, with results coming in ahead of expectations on both the top and bottom lines. Total revenue was $2.6 billion, which was up nearly 8% from the same period a year ago. Volume was down 3%, to 1.2 billion pounds, but better pricing helped drive the top line higher. Second quarter revenue number was a record. Hormel's main competitive advantage is its 30-plus products that are either in the number 1 or number 2 of their category. Hormel has brands that are proven, and that leadership position is difficult for competitors to topple. In addition, Hormel has a global network of distributors that few food companies can rival. Next, we have Aflac, and they're number 7 on the list of no-fee drip dividend aristocrats, and they were formed in 1955 when 3 brothers, John, Paul, and Bill Amos, came up with the idea to sell insurance products that paid cash if a policyholder got sick or injured. In the mid-20th century, workplace injuries were common, with no insurance product at the time to cover this risk. Today, Aflac has a wide range of product offerings, some of which include accident, short-term disability, critical illness, hospital indemnity, dental, vision, and life insurance. The company specializes in supplemental insurance, which pays out to policyholders if they're sick or injured and cannot work. Aflac operates in the US and Japan, with Japan accounting for about 70% of the company's revenue. Because of this, investors are exposed to a little currency risk. Further, Aflac has increased its dividend for 39 years in a row, making it a true dividend aristocrat. Johnson & Johnson is a global healthcare giant and is number 6 on the list. It has a market capitalization above $400 billion and generates annual revenue of more than $81 billion. Today, Johnson & Johnson manufactures and sells healthcare products through three main segments: pharmaceuticals, medical devices, and consumer health products. They have a diversified business model with strong brands across its three core operating segments. On July 21st, 2021, Johnson & Johnson released second quarter earnings results for the period ending June 30th, 2021. Revenue increased 27.1% to $23.3 billion, which was $770 million above what analysts had anticipated. Adjusted earnings per share of $2.48 was 81 cents, or a 49% improvement from the prior year and better than expected. Johnson & Johnson has increased its dividend for 58 consecutive years, making it also a dividend king. Number 5 on the list is 3M, a diversified global industrial manufacturer. 3M manufactures about 60,000 products sold in 200 countries around the world. 3M came to dominate the industrial manufacturing industry through a sharp focus on the most attractive market segments. And 3M has increased its dividend for over 60 consecutive years and is also on the exclusive list of Dividend Kings, a group of stocks with 50-plus consecutive years of dividend growth. And by the way, here's a video about some other Dividend Kings that investors are looking at. Check it out. Okay, so after a significant downturn in 2020 due to the coronavirus pandemic, 3M has seen a strong recovery so far in 2021. They've invested heavily across its core areas to build a leading product portfolio. 3M is composed of 4 separate divisions. The Safety and Industrial Division produces tapes, abrasives, adhesives, and supply chain management software, as well as personal protective gear and security products. The Healthcare segment supplies medical and surgical products, as well as drug delivery systems. The Transportation and Electronics Division produces fibers and circuits with the goal of using renewable energy sources while reducing costs. And the Consumer Division sells office supplies, home improvement products, protective materials, and stationery supplies. All right, so before I get to number 4 on the list, remember that promo code I mentioned earlier for the Sure Dividend newsletter? Well, folks, because you're watching this video, you can go ahead and use my coupon code FIM41OFF to lock in savings of $41 a year and get instant access to the newsletter with a 7-day free trial. And by the way, I also left you a link in the description below. Federal Realty is next on the list of no-fee DRIP Dividend Aristocrats, and they were founded in 1962. As a real estate investment trust, Federal Realty's business model is to own and rent out real estate properties. And it uses a significant portion of its rental income, as well as external financing, to acquire new properties. This helps create a snowball effect of rising income over time. Federal Realty primarily owns shopping centers. However, it also operates in redevelopment of multi-purpose properties, including retail, apartments, and condos. The portfolio is highly diversified in terms of tenant base. Federal Realty has a high-quality tenant portfolio, and the trust investment strategy is to pursue densely populated, affluent communities with high demand for commercial and residential real estate. This strategy has fueled strong growth over the past several years. And last year, in 2020, well, it was a difficult year for Federal Realty and the entire REIT group as the coronavirus pandemic caused store closures across the country. These impacts have lingered through 2021. However, the sentiment is starting to improve. Next on the list, we have Realty Income, a retail-focused REIT that owns more than 6,500 properties. It owns retail properties that are not part of a wider retail development, like a mall, but instead are standalone properties. This means that the properties are ideal for many different tenants, including government services, healthcare services, and entertainment. Realty Income is a large cap stock with a market capitalization of over $25 billion. The company's long history of dividend payments and increases is due to its high-quality business model and diversified property portfolio. Next, we have Abbvie, a pharmaceutical company spun off by Abbott Laboratories in 2013. Its most important product is Humira, which is now facing biosimilar competition in Europe, which has had a noticeable impact on the company. Humira will lose patent protection in the US in 2023. So Abbvie's major risk is a loss of exclusivity for Humira. Fortunately, the company's massive research and development platform is a competitive advantage. Research and development expenses totaled $6.5 billion in 2020. Abbvie has multiple growth opportunities to replace Humira, particularly in the therapeutic areas of immunology, hematology, and neuroscience. And last but not least is Exxon Mobil, an oil and gas giant that makes the majority of its earnings from its upstream segment, with the remainder from its downstream, mostly refining segment, and its chemical segment. Exxon's growth potential is challenged by the recent decline in commodity prices, as well as the global recession due to the coronavirus pandemic. The company announced that it's going to reduce capital expenses by $10 billion to preserve cash in this difficult environment. However, thanks to its promising growth prospects, Exxon expects to grow its production from about 4 to 5 million barrels a day by 2025. The Permian will be a major growth driver, as the oil giant has about 10 billion barrels of oil equivalent in the area, and expects to reach production of more than 1 million barrels a day in the area by 2025. Guyana will be another major growth driver of Exxon. The company has nearly tripled its estimated reserves in the area, from 3.2 billion barrels in early 2018 to nearly 9 billion barrels now. Folks, enrolling in a dividend reinvestment program can be a great way to compound your portfolio income over time. That being said, many investors prefer to selectively reinvest their dividends into their current best investment idea. This ensures that DRIPs don't automatically purchase stocks that are overvalued. For dividend growth investors interested in DRIPs, the 15 companies mentioned in this video are a great place to start. And each business is very shareholder friendly, as they all have long dividend histories and a willingness to offer investors no-fee DRIP plans. Folks, thanks so much for watching. This has been a lot of fun. I'm going to see you next video. See you.